So welcome, everyone. Again, you know I'm Kathleen McAllister, and we have three outstanding practitioners with us today. We're going to discuss mergers and acquisitions. We're going to get the latest and greatest. So we'll start with our first question. We'll start with the landscape, and this is going to be for Matt. With M&A activity has been shaped by a lot of cross currents: interest rates, regulatory scrutiny, sector-specific disruption. And Matt, from where you sit, what's actually happening in deal flow right now? And what should board directors understand about the current environment?
So 2026 so far, it's not shaping out to be as active as a lot of people anticipated coming into this year. That said, there is plenty of deal activity. A few of the different things that we're seeing. I mean, first in the very large strategic, kind of deal space, that's potentially poised for a banner year. These are deals like Houston Cisco Foods acquiring Restaurant Depot, the Skydance Warner Brothers merger, Deutsche Tel and T-Mo is being discussed at the moment. I'm sure a lot of you have seen as well. And so for that level, what's kind of underpinning these types of transactions, or kind of a number of things that we're seeing. First is organic growth, and the kind of idea that growing as quickly as companies would want is not going to necessarily happen purely organically. So then if they're going to go and make a deal, then let's do something large and that's transformative, is another element. At the moment, there's a sentiment that the antitrust process is more predictable. Not that it's gone away, but that there's greater confidence in what reviews will entail. Then a final factor is additionally that move now while rates are where they are potentially before they become a greater issue. So that's kind of underpinning a lot of these deals. Something I'll say for me in particular, working energy and infrastructure in Texas, is there's a trend of mid-cap energy consolidation, and then also because of AI, a lot of data center and adjacent infrastructure transaction activity that's happening.
Okay, thank you. Boy, that you hit pretty much everything on that, I think. But I like the a little bit more certainty maybe on the regulatory front, a little bit more predictability. So you did mention the consolidation of middle market energy operators and the growth of data center assets tied to the AI demand. Could you expand on that and talk about what's driving those trends and governance implications that boards should anticipate?
For sure. So I guess first on the energy side, the mid-cap operators are at risk of being subscale. So the 2010s, we saw a shell boom where a bunch of companies went and acquired a lot of acreage, were pushing for production that has now left them in situations where it's hard to meet investor expectations. So addressing that is through consolidation, where a few things are coming into play. You've got inventory duration, which they'll improve that through consolidation, which is one of the primary value drivers. And then additionally increasing operational density, which helps address the cost profile of the businesses. And so that's what consolidation is addressing. And then another element that we're seeing is, in particular for sponsor-backed businesses, a lot of these are 10 years into their investment, and so now they're getting the pressure of returns or liquidity, depending on that situation. So that's energy. On the data center side, I'm sure everyone's hearing about AI all the time and asking, having conversations about what it entails and how to apply it in your companies. So the demand on compute is skyrocketing, and to help fulfill that, some of the bottleneck items are land, access to power, cooling, and services, all of which Texas is very well positioned to provide. So that's kind of what's, I'd say, driving those trends that I'm seeing in those areas. To your question on for the board, and I guess what could implications for that, a few things come to mind. Oversight of capital allocation, so decisions of build more infrastructure versus acquire, Then also, paying down debt versus distributions is one area. Cyber governance is really big. These are critical assets for our country, and so making sure that they're secure, in particular given the geopolitical environment. In the consolidation scenario, we've got looking at leadership, comp, and succession, which I know Mark will be able to talk more on. And then lastly is ESG. So that's not gone away. What I've seen is the shift has changed more on power and water management type items, safety in particular as well are some of the themes that come up for in the ESG space right now.
Thank you. A lot to think about. Chet, let's turn to the board's role. So when a company enters M&A territory, whether it's as an acquirer or as a target, what are the core fiduciary duties directors need to understand, and where do you see the boards being most vulnerable in today's environment?
Yeah, so that's so everybody here, in some capacities, and probably a board member certainly understands as a board member, you have kind of two principal fiduciary duties, the duty of loyalty and the duty of care, right? The duty to act as a reasonable person would, act in good faith. And those duties exist in any M&A context, whether you're on the buy side or the sell side. So those continue. And they're slightly enhanced, I would say, in that the expectations are a little bit higher when you're doing an M&A transaction. And primarily, particularly if you look on the sell side, that's where you see them becoming more enhanced and potentially even enhanced to the extent that those duties shift not only from just acting as a reasonable person would, but also getting the best value for the bank. Because if you're in if you're selling your bank, I say bank because I represent a lot of financial institutions, but your company. But if you're selling your company and you're selling it for cash, so you're selling control, then there's some case law that basically implies these enhanced duties called the Revlon case, which means your duty is to maximize the value to those shareholders. And so it's not just the basic duty, but it's enhanced. And in doing that, that means a lot more, it's more important, and this is true regardless, and certainly on the sell side, is to manage the process, document the process of what you're doing, how you're involved, even though, management may be doing a lot of the due diligence, but you have to make sure that you're asking the right questions, following up, getting reports, and not just relying on basic summary due diligence reports, but really dig a little bit deeper, ask the tough questions, because at the end of the day, those minutes that are being drafted in those board minutes in those board meetings are really going to be your best protection if there is any kind of litigation. Now, litigation's rare, and we might talk about that a little bit later, but I think you have to have an eye towards making sure you're documenting this process and that you're going through a thorough process. And so again, on the sell side, the other issue that comes up is also maintaining the independence, because inevitably, typically on the sell side, you've got certain conflicts of interest that might arise because you've got an executive that's getting some type of compensation from the buying company, and you need to make sure you're managing that, or if you've got principal shareholders or other assets are being sold outside, you've got to really identify those conflicts and manage those as well. As you flip to the buy side, the duties aren't quite as high. You don't have this notion of these heightened duties under Revlon, but it's still important to go through and pay attention to diligence, making sure you're asking the right questions, identifying what are the key risks here, how are we managing those risks, how are we going to mitigate those risks, and really asking those questions and being involved in that process. Because at the end of the day, it is really about risk management, because the one thing I know from any acquisition, there's always going to be a surprise at the end, and you're just hoping that, and there'll be multiple surprises probably, you're hoping that the good surprises outweigh the bad surprises, but you're also planning for that kind of worst case situation, or at least the surprises that come up after the deal closes.
And one thing I'm thinking about is how fast these deals move, and you're trying to cover all the bases, and you're getting a zillion emails every day.
Well, and that's a good point, because, I mean, speed does kill deals, but also if it's moving too quickly, something's going to get overlooked. So you've got to be careful about that process. And part of it is the optics of the process that you're trying to go through. Because if you sign up a deal in 10 days and it's a $100 million deal, well, that's probably not a reasonable process, right? So, but be careful in the sense, and particularly as an outside director, that you feel like you've gotten the information and you're getting that before you're putting that to a vote, because making a rush decision is a real risk for a fiduciary, and just in having that process organized and having somebody that's managing it. Part of it's getting good advisors and getting good people that are helping you on your third parties doing your due diligence, and making sure you can rely on those advisors, because as a board member you can't keep track of it all, but ultimately you need to be cognizant that it's going right, and you don't feel like you're getting rushed. If somebody sends you an agreement the day before, a 50-page agreement or a 100-page agreement, and says you need to look at this because we're voting on it tomorrow, you need to probably say, time out. That's not right. I can't reasonably do that. I mean, and so be careful about it, and but knowing that every deal is you're going to feel rushed. That's part of the process in any deal.
So a bit of a follow-up for our other two panelists, if you want to chip in on this. So Mark or Matt, from your vantage points, where do you see boards coming, to the table sort of underprepared on governance?
So a lot of it is, and you may have already kind of touched on this, but there's a lot of focus on getting the deal done, and there's not a lot of focus on the consequences of what is unknown or unresolved ahead of that. And I'm being very general, but if I put my comp hat on, it's really related to what pieces are left over from the previous company, what is going to leave the new executive team undermotivated or not as engaged because they didn't come out of the deal exactly the way they thought it would be. So these are kind of unintended consequences, I guess.
One that I see is, and it kind of, Chet touches on the theme that you're talking about a little bit of pace and being prepared, is helping test the timing of critical steps into the transaction, and the right balance, but between pace and risk. And example that I have from a recent deal that we were supporting that involved a acquiring company pulling in a few thousand employees, and there was a very short sign to close window, and the management team's preference was to onboard all employees, transition employer on day one. There wasn't anything in the transaction construct that mandated that, but that was their preference, and the window was really small, and they're at risk of messing up comp and bin for a few thousand employees, which of course you don't want to do coming out of the gate as the new owner. So helping test things like that of the critical steps and the timing and the trade-off between pace and risk, I think is important.
Okay, good. Thank you. Thank you for the additional color. And Chet, when you mentioned getting the 50 or 100 or 300-page document, I used to feel like I needed to understand the entire thing, and I'm not an attorney. And so I don't think any of us should be shy about saying, hey, I need a summary of this, especially now that we have AI. But I need a summary of this, and I need our outside counsel to be in the meeting with us to take us through this and explain the nuances of these, very important sentences with very important words in them that all have all sorts of background, law and regulation and case law and all sorts of interpretation that a non-lawyer may not fully appreciate. So I do think in terms of, and that leads me to kind of my next question, which is it's for Chet, expanding a little bit on documenting, and you touched on this in your comments, but when we talk about documenting our deliberations and decisions throughout a deal process, there's a wide spectrum. Some directors like to take notes. Some directors like to have the general counsel take minutes. Outside counsel sometimes is taking minutes. Can you just talk about the whole spectrum and how we ought to think about that side of it.
And some people like to record them on Otter or some other, I mean, so there's all, I mean, which is legally, I would tell you that's a bad idea because you don't want that out there at all. And in minutes of these meetings and documenting the record are important because, as I mentioned, that's going to be the sole record of what's going to judge you. First thing is going to judge you. Yeah, there could, if something goes bad, and that's really, you're thinking about that kind of protection as you think about what minutes really do. And there's a fine balance between them being too brief and too inclusive. So it's finding that kind of magic mix where they really talk. If there are certain issues that are important, then there's a focus and show that there was a discussion, that you looked at certain reports. And so maybe instead of 2 sentences about the board looked at it and discussed it, you would say, we also analyzed these, and several board members asked questions specifically about X, Y, and Z, and what are the risks, and we identified it. And so you've got 4 or 5 sentences on that discussion topic. And so without going too overboard, I think is the key, is again, thinking about it and having outside counsel or somebody that really understands that to be able to go through those minutes at the end of those meetings, and is probably good advice, particularly if you're in a public company or something that's more, you kind of got a higher fiduciary risk kind of transaction.
All right, thank you. I think good discussion on this. Lots for us to remember the next time we're in an M&A deal on documentation. Mark, I have a question for you. We'll shift over to executive compensation. So that's a piece of, and you touched on it earlier, that's a dimension of M&A that doesn't always get the board level attention it deserves until there is a problem. Can you talk about the most significant compensation and retention issues that we need to, as directors, own during the transaction?
So it starts with who matters. The management team is selecting that group who is most critical in their eyes of having success with the deal. The board should be very interested in this time on the selection of that team and whether they deem that critical as well. There are very specific things like overpaying versus losing an executive. A lot of times that's cheaper to do, but you can't overpay everybody because then it's just expensive. And not everybody's critical, because if everybody's critical, nobody's critical, basically. So really starts with the team and then goes to the way they're being incentivized. That plan that is in place needs to tie to the deal thesis. They have to have a way of making that deal successful. So very critical. A lot of that design happens as part of a negotiation, but in the end, that needs to tie to the success of the deal going through. And then cost. Cost is a big piece that a lot of times, and Chet kind of mentioned things that you find out later. There's the change in control payouts. There are retention arrangements. And then sometimes there are hidden liabilities that just crop up, but there should be an attempt to understand what the cost of bringing all that aboard is.
You touched on, I have a follow-up then, you touched on retention, which is kind of a post-deal strategy.
Right.
Can you talk a little bit about the board's role in oversight of the retention strategy?
Right. So post, it goes from, it's not really a finish line, it's more of a reset button. The compensation needs to start evolving from the stability of the team to driving performance, and that can happen at different, depends on how the plan is laid out, but generally you're going to want to start having that conversation very early, or they have that plan already determined ahead of getting too far. And then once that's in place, the actual monitoring of that plan. So the board should be taking a great deal of interest in being visible at this time, interacting, playing that real oversight role because there's a lot of critical things that happen this time, and they're doing they should be taking a lot of attention on this team and evaluating those successes and failures. The other thing is they should be monitoring, is the program being delivered, and again, I'm thinking from a compensation standpoint, is that program being delivered, is it successful? Are they, is the behavior positive to what the program is supposed to be doing? So they should be looking for any of those troubling signs, like any disengagement from any of the executive team. And then, this happens too, any unforeseen turnover. Those things could be indicators of other things. And sometimes when you find these things out, it's before it's hitting you, and those items are hitting you before it hits the books, but you may not know that until some of the damage already happened. So all these things should be monitored very closely as that team is finding their way across a 6 to 12 month period or whatever the particular window is.
Thank you. That's a good insight. So we'll have we have 2 quick questions before we switch over to our table discussion. So one, starting with you, Matt. Significant conversation about AI's role in M&A and in deal sourcing, due diligence, and in post-merger integration. Can you tell us what you're seeing in real life on these topics?
Yeah, for sure. So seeing it come up in a lot of different use cases. Where I'm seeing it most effective at the moment is actually on the pre-deal side. So for instances where you have highly acquisitive companies and helping fill the top of the funnel in terms of target identification and kind of initial screening is one area that's working well. Second one is an actual kind of the initial due diligence and the various functional domains that you'll typically perform this in. We have capabilities, we're able to ingest a data room and get to kind of the level 1 diligence analysis in hours, whereas depending on the size and complexity of the deal, it would have previously taken days or weeks. And so the ability to get to, yes, we're going to pursue this, or oftentimes just as valuable, no, we're not, faster, is stuff that I'm seeing work well. I'm not seeing it as effective on the post-deal side yet. If you think about integration activities or carve-out activities, I'm seeing it used in a lot of different use cases. One kind of that comes to mind that we were working through recently was around helping look at consolidating contracts, both commercial as well as with suppliers, and using AI to help assess with that. And found that there were misreading of some contracts in some material ways that were caught kind of by reviewing it alongside. And I think that'll come along and get there. It's just an area where I'm not seeing it as effective quite yet.
Okay. Well, just filtering the funnel, that's huge. Chet, quick question for you. You emphasize planning for post-deal integration before the deal closes. So what's the most common failure mode, and what should a board be asking management before signing?
Yeah, and I think the question really states it. I think it's waiting till you close the deal or right before you close the deal to start planning. You should be thinking about integration the moment you're doing it, from your due diligence standpoint at every level, because it's more important to really have that, because integration risk is going to be one of your biggest back-end risks that you're going to have to assess anyway. And so thinking about, okay, what are the people risks that we just talked about? And that's important. And so all that gets kind of really built in the due diligence process, and then you're having your list on how are we going to control that risk. Well, part of it goes to your integration plan, and then being able to start that, because if you wait until you're about ready to close the deal, you're already behind, because most people, I say, buyers estimate the distraction that it is from the company, and you've got that kind of distraction risk in any acquisition, that you're taking your eye off your other ball because everybody's focused on this, or you don't execute on your integration plan, and so then the acquisition is not as successful as you planned.
All right, thank you. Good advice. We've covered a lot of ground in a short time: the deal environment, fiduciary responsibilities, compensation and retention, and the emerging role of AI in transactions. So thank you to Matt, Mark, and Chet for bringing such a practical perspective to this room.